Hello and welcome to the Mayar Capital Annual General Meeting. My name is Lee Overall-Gibbons and I'm the Head of Client and Relations at Mayar Capital, so good to meet. Here today we're going to discuss the Mayar Responsible Global Equity Fund, and we're going to do this over two stages. We're going to look at where the fund has come from and the outlook, and then we will follow on with a Q&A. We expect the session to last approximately 45 minutes. Now, with regards to the best viewing for this presentation, I would recommend that you select the speaker view and also put your microphones on mute and cameras off. Now, this meeting is for you, so please do ask your questions. We will be happy to answer them in this session. But for any that we don't get round to answering, then we will respond individually after the session itself. Now, to help me through this discussion on the Mayar Responsible Global Equity Fund, I have two guests. Aziz Al-Nain, who is the Mayar Capital Managing Director and Portfolio Manager. And joining Aziz will be Aubrey Bockelbank, who is the Head of Investment Research and also the Deputy Portfolio Manager. Now, with regards to where the fund has come from, I'd like to hand over to Aziz and Aubrey to gauge their thoughts and views.
Thanks, Lee, and welcome everyone. Thank you for joining us today. I want to start by first reminding you and us about the background to the fund, where we are, and some of the core things that I think define us and define the global strategy that we've been running here at Mayar for more than 13 years now. We think of ourselves as, first and foremost, value investors with a quality bent, and we're going to talk about this a bit later in more detail. We believe that the best way to generate great returns over the long term is to be a high conviction manager, to be active, to hold 20 to 30 positions in the best ideas that you have and concentrate your capital to generate the best risk-adjusted returns. We always think about risk before return. We've promised you this on day one, and we'll always continue to hold this promise. And this means that we tend to have good downside protection over time. We believe our strategy will outperform over the long term, but does sometimes have periods of underperformance, specifically towards the latter parts of a market cycle. And speaking of that, let me also remind you about our process and how we do things at Mayar. As you know, everything starts with what we call Mayar's ethical business owner approach. It means we invest responsibly. It means we factor ESG factors into our investing. And it means that we're also Sharia compliant. We've always been obsessed with process. And the reason we've always been obsessed with process is that we accept that human beings are vulnerable to behavioral biases. And the only way to ensure that we overcome these biases is to have a robust process in place. It will ensure consistency, repeatability, and it will also have a mechanism to learn from our mistakes and have that feedback back into our process so that over time we continue to do better and change while still, but also stay true to our core fundamental beliefs. Now, while a process does not ensure success over time, what it does ensure is consistency, and that's extremely important for us. And we'll talk a bit later about why consistency is so important. This is our performance over several periods since inception, and you can see, as I'm sure you know, that the past year and the past 3 years have been disappointing. But if we look at how the strategy has performed over the very long term, especially since inception, you can see from here that it not only did exceptionally well against the MSCI World, it did extremely well against a host of other indices that are trying to do things similar to our investment style. And while the last 3 years have been extremely disappointing, and we'll be the first to admit that, We also think that it is inevitable that we're going to have periods of underperformance, and we're going to try to dig deeper into that shortly. This is not an excuse, but we will try to explain what happened, what we've learned from it, and why we think this is temporary, and why the future is going to be bright, and why we have a lot of confidence in our strategy and our process. This bridge chart or waterfall chart shows our performance over the past 3 years compared to the performance of the MSCI World Index. And we'll dig into different parts of it to try to better understand and explain to you what has happened. Now, the left side of the chart are things that we own that have done worse than the benchmark since we've bought them and have produced disappointing results. And we think of those as mistakes of commission, basically stuff that we've bought that hasn't worked out as much as we thought it would. And on the right side of the chart, you will see things that we have not owned that are part of the benchmark that have outperformed our portfolio. And so these are things that did better than our portfolio and thus better than we expected. And we think of those as mistakes of omission. And you'll see in a little while why this right side of the chart is the key explainer for underperformance over the past 3 years. So let's take the things that I've highlighted here in red. The first two I've put the word mistake on top of. And there are two investments where we've admitted in the past that we've made mistakes in our analysis and in our decisions, and have been obviously, and have led to disappointing outcomes. I do want to emphasize, though, that the rate of mistakes that we've had in the past 3 years and the magnitude of those mistakes is not different from what we've experienced in previous periods. We will make mistakes from time to time. We will learn from them. And it's actually the fact that we expect to make mistakes is why our process is designed in a way to minimize the damage of those mistakes, and why we insist on having a margin of safety when we do invest, because it protects our downside when we do make these mistakes. The third one, I've put a red box around, and I've written COVID on top, because it is very difficult without the benefit of hindsight, I think, to know whether it was a mistake or was just bad luck. Now, while there's no doubt that performance of Nordstrom during the period that we owned it, and as again we've talked about this in the past and we've sold it a couple of years ago, the performance has been disappointing. I do believe that a lot of the negative outcome that we ended up with had to do with the early days of COVID, when Nordstrom had to borrow a lot of money to stay in business. And if it wasn't for COVID, that I think the thesis that we had going in would probably have worked out. At the very least, I am very confident that it would not have been as bad an outcome as what we ended up with in reality. But in the end, it is still a mistake of commission. So something that we bought that didn't work out. And again, even when counting Nordstrom, the severity and the frequency of mistakes is consistent with what we've experienced in the past. And that's just natural that we're going to make some of these mistakes. The next group I'll hand over to Aubrey to talk about are things that are still works in progress that we still have confidence in and expect that our patients will be rewarded for. But Aubrey, maybe you could dig deeper into these.
Yeah, certainly. So UPS is one we talked about this time last year. This time last year it was one of our best performing stocks. But sadly, it's given up some of those returns. But it had done very well because it was a COVID beneficiary. And, obviously people had used e-commerce an awful lot more during that period than they are now. So revenues, volumes were down about 8.5% last year. And part of that was because of sort of no longer having to buy everything online. But part of it was also the unionization because they have very strong unions, and they had strikes in the Teamsters really negotiated very hard, and part of that led to a decline in volumes, but also temporary decline to their margins as they negotiated better wages. Now, we knew the normalization was coming of the revenues, because that was really to be expected, and the Teamsters, we didn't see that coming. We knew it was a risk, and it was at a price. We owned it at a price where we thought that was to be expected. It was priced in. We thought, but we look at the future and go, well, look, this is still a business that is going to be able to grow at mid to high single digits. It has good pricing power. It is so exposed to e-commerce that you cannot imagine a world in which e-commerce does well, as we all believe it will, and that this business does not also do very well. And then we also see revenues margins normalizing, over the next few years. And all this for a business that is now trading at about 14.5 times earnings. Well, we just think that is too cheap for this business, and it has that potential. PayPal, obviously, it's been disappointing in terms of the share price. However, on the fundamentals, earnings have grown from $3.09 a share to $3.92 a share since we've owned it. So, the earnings are up significantly. It is just the derating that has happened. At the same time, we have seen gross margin, the take rates decline, but that's through a portfolio shift, but not in absolute dollars, only in margin, because you have the unbranded business, which is growing much faster. So, in absolute terms, it is still doing, better than it was when we bought it. But it's trading at 16 times earnings. Well, at 16 times earnings, that's only pricing in 3% growth. And again, we go back, do we think that, e-commerce is only going to grow at 3% for the foreseeable future? Well, no. I'm almost certain it's going to grow at, something quite in excess of that. And if that is the case, well, then, all the operational improvements they've put in place, are just going to lead to higher returns eventually. So I'm, really quite comfortable with where we are on these stocks. But, this is part of our process, or part of our, strategy, that we invest in stocks where we look forward in time and we look through short-term issues, and we have to have the patience in order to get these rewards.
I mean, often that's why these opportunities exist, is that the average investor does not have the patience to wait them out.
Yes.
Yeah. Moving to the right side of that chart, this is the bulk of the underperformance that we've exhibited the past 3 years. And so if you look at this is almost 15 percentage points roughly out of 23 or 24 percentage points. So this is where essentially most of the underperformance has come from. And this is what I've dubbed earlier mistakes of Omission. So this is stuff that we did not own over the past 3 years that have done exceptionally well. And the bulk of this, almost all of it, is what we now know as the Mag 7 or the Magnificent 7. And because of how important this difference is, and how much negative contribution it's done, it's added to our relative performance, I want to dig a bit deeper into it and try to explain our thinking behind it, and what's led us to the position that we're in. So the Magnificent 7, you've heard about them probably from others before, and you've definitely heard about them from us. They are Amazon, Apple, Google or Alphabet, Meta, Microsoft, and NVIDIA. And these are big US-based, globalized technology companies that have done exceptionally well as businesses over the past several years, and whose stock prices have just absolutely rocketed, especially the past 2 or 3 years. And to put things into perspective, these companies now constitute more than a third of the Standard & Poor's 500 index. This is unprecedented concentration, not only in a small number of names, but names in one sector. And another way to see how lopsided this performance has been is to look at, for example, the S&P 500 compared to the equal-weighted S&P 500. So the equal-weighted S&P 500 is the same constituents, the same 500 names, just equally weighted instead of market cap weighted. And the differential between the S&P and the equal-weighted index is at an all-time high over this period. We have never seen anything like this. The only thing close to it was the late 90s during the tech bubble, but it's worse this time, and it's certainly more concentrated. And what this says is that the average stock, if you look at what happened to it's the same with the MSCI Equal Weight, the average stock has basically gone nowhere over the past 3 years, which is very similar to our performance, unfortunately, whereas all of the gains in the index have come from this small subset of the market. And what that means that if you are an active manager, if you're a concentrated manager like we are, it makes it extremely, extremely unlikely that you're going to outperform or even keep up with the benchmark, because it requires that not only do you own these names in such a high concentration, you are putting more than a third of your portfolio in 7 names, all of which are in one industry, all of which is in one country. And we're not willing, purely even on those bases, before getting into the valuation, we're not willing to take that kind of risk. We don't think that's a sensible amount of concentration to have. Now, these things happen from time to time. They tend to happen later in the cycle. But then the other thing, as we have seen from history, is they also tend to eventually revert, and things do end up normalizing. And we are seeing evidence recently of this starting to happen, where you're starting to see the rest of the market catch up. And it's one of the things why we're optimistic about the next few years. But the other thing that I want to highlight here on why is it that we don't want to own these names, it's not like we don't believe these are fabulous businesses. We do. We think these are great businesses. We actually owned many of them in the past, but we just think the valuation has run ahead of itself. And the reason valuation matters is that once valuation exceeds what is a fair value or even a slightly overvalued level, no amount of growth can produce great returns for investors or even acceptable returns for investors, even if you hold for a long period of time. And this table that you see is something that I put into the Q3 letter from last year, and I called it the OG7. And what I did is I looked at the 7 most popular stocks in 1999 and tried to see how well they've done over the 10 to 15 years after that. And you would have bought that were and are great businesses. Maybe GE had some stumbling during that period, but generally speaking, as a group, this is a group, and you can see this in the far right column, that had continued to grow and continued to grow at very high to exceptionally high rates. And yet, if you bought a portfolio of these stocks in 1999, you would have made no money for 10 to 15 years. And that's even counting dividends that you would have received. It would have been an extremely disappointing outcome, even though you would have been, even if you have correctly predicted that the performance of the businesses and the fundamentals were going to be as great as they were, you still ended up with a terrible outcome as an investor, and you would have been better off owning the rest of the market over that period. And this is the peril that we think is happening today. And while we're not trying to predict specific outcomes for the market, or sorry, for a certain number of stocks in a 3-year period or a 5-year period or a 10-year period, the valuations that these names trade at today make it exceptionally unlikely that you're going to have a positive return by owning them over the next few years. And we think that the risk reward is just not justified. These are names where we think if the market takes them back to where we think is fairly valued, the investor could end up with a 50, 60, 70, 80% loss on capital. That's just not an amount of risk that we are willing to take with your hard-earned money. And that's why, and as we've said before, because we think risk before return, we are happier, maybe not happy, but at least accept that we're going to sit on the sideline, wait it out, stick to our knitting, and know that over the long term, our patience will be rewarded. Aubrey?
Well, yeah, so, I mean, let's just sort of provide a little bit more detail on some of the names in the Mag 7. I mean, obviously there's Tesla, which, I don't know, I'll leave that till later. We'll probably get asked about it.
Always do.
Exactly. But it is down, what, 30 to 50%, at 50, I think, since peak. But, the others, they're the ones that have done really well. And, well, we own, as you said, we owned a lot of them. Apple we used to own, but it's $3 trillion market cap company on 30 times earnings now. Now, at 30 times earnings, you have to be able to grow sustainably at around 7%, 8% in order to justify that multiple. And at 3 trillion market cap, I sort of fail to see how they're going to be able to grow
That's
sales.
Doubling in 10 years.
Yeah, are you going to double the amount of iPhones you sell? Well, given that they're the sort of biggest phone manufacturer, I really struggle to see that. Maybe they will. Maybe everyone's going to have 2 iPhones, but or they'll come up with some really cool glasses, or I don't know what. But I have to speculate a lot to get there, and that's what we don't like to do. We don't like to speculate. We will pay up for growth when it is clear in front of us, but we won't speculate. So, for instance, with Vestas, when governments have said how much wind they're targeting, as a percentage of the sort of total energy base, we can go, okay, well, this means that revenues have to go from here to here. We can see that. It's very clear. It's very predictable. If you are, trying to bet on, people having 2 iPhones or a new products coming out that we've never seen, that's just pure speculation. And, we don't do that because that is too big a risk. And we have the same issue with Microsoft. There the growth is perhaps, more likely to happen, but it just requires more assumptions for us that we're not able to take. Actually, I won't talk about Meta because I'm, one of 12 people that doesn't have a Facebook account. But let's talk a little bit more about Nvidia because I think that's the big one that is really hurting, most sort of managers with a value bent. There are good reasons to own it. When you hear the bull case, it does sound very convincing that they have this absolute monopoly on the coolest, most brilliant AI chips, and they're going to keep that monopoly forever, and they're going to keep these margins. But I struggle to see that, and there are there are lots of reasons I struggle, but let's just focus on the main one, which is that at the moment they are a monopoly. They've got CUDA, this software that locks people in, but their customers, not just their competitors, their customers, Meta, Microsoft, Amazon, Google are getting together to write their own software as a group to compete that will be open source, so they're not locked in to NVIDIA. They're also alongside Intel and AMD and ARM. They're also trying to build chips that are going to compete and compete for specific applications. Now, you cannot go from a position of monopoly to competition and not see margin decline, especially when their margins have gone from a normalized base of something like 30% to 70%. These are super normal margins and great for them, and I hope they enjoy it whilst it lasts. But, I've never seen a business enjoy those margins when competition enters the market. And so to buy it, you have to believe that, Meta, that Microsoft, that Google, Intel, AMD, when they combine their forces, are not going to be able to produce something that is competitive. Doesn't even have to be as good, just competitive. Now, given the resource, the cash balances that those guys have, I find that very, very hard to believe. Now, again, I could be wrong, but when I look at the risk and the reward, I think, okay, well, what happens if margins for NVIDIA do go back to 30%? What happens if they then do derate to a normalized multiple? Well, then we could be looking at 60, 70, 80, possibly even 90% loss. Well, it's not offering enough upside at this valuation to justify that kind of risk. So, we stay away from these things. And sure, it hurts when they go up. And even if we know, look, it's probably going to still do very well for the next year. Momentum is behind it. This competition that I've been talking about, it's probably going to take a year or two, possibly 3 years to come in, but we know it's coming. So, okay, maybe we could buy it. No, we can't buy it before then because you don't know when the stock market's going to react. We're not traders, we're not speculators, we're investors. We invest on the fundamentals, and the fundamentals at the moment, to me, just say no.
No, I think that's a very good point, and I think one could argue that we could have made this point a year ago and would have been kind of wrong about the outcome. And my reaction to that would be twofold. One is this is the nature of anything where, well, that's the nature of risk essentially, where you could have a highly unlikely outcome happen, so a highly unlikely positive outcome happen, but we would not make that bet. And one of my favorite sayings is from Joel Greenblatt on this topic, and he says, just because you walk through a dynamite factory with a lit match and survive to tell the story doesn't mean that you're not an idiot. And so it is one of those things, and probably the challenges of that we have to face all the time is that we know whenever we make a decision that there is a small percentage, maybe even a 20, 30% chance that the unlikely outcome does happen, and we have to risk looking like idiots when it does. But the more likely outcome is just so unacceptable that we're not willing to take that risk. And our job isn't to avoid risk, so don't get me wrong, but our job is to, A, take sensible risks, and more importantly, make sure that we are paid for taking those sensible risks. And I just don't think that's the case here. Obviously, time will tell, but I do think that the outlook for these names from the stock perspective, not from their businesses perspective, or from their stocks, just strikes me as extremely unattractive from a risk-reward point of view. Good, but one other things that I want to get into, because I don't want us to sound like we're just sitting this out on the sidelines and doing nothing. So yes, we're avoiding these unattractive risks, but we are making sensible decisions and sensible investments. We're not sitting on the sidelines with cash. In fact, we're fully invested now. And maybe I want to give you, Aubrey, the opportunity to maybe talk about some of the specific names that we're most excited about that we think are going to contribute to our performance in the future.
Yeah, absolutely. So look, let's take Unilever to begin with, which is, I think our largest holding at the moment. It's recently done quite well, which is, one of the reasons it's the largest holding. An activist investor has just got involved, and whilst it's always been a good business, which is why we've always owned it, and whilst it's been reasonably valued and had good returns, good margins, good prospects. There have been elements to the business which have never been as optimal as anyone would have liked, such as the ice cream business. And their top brands haven't had as much focus as perhaps we would have liked. But Tryon have sort of forced the issue, and now they really are focusing on this. They're focusing on their top brands. They're getting rid of the ice cream business, and therefore we're going to see improvement in margins, or at least we're hoping and we believe that we should see margin improvement with continued really decent mid to high single digit growth, and for a business that's trading at a reasonable multiple. So we are pretty happy with this. Now then could look at Bright Horizons. This is another stock that we've talked about quite a bit, but again, it's the utilization here post-COVID has really not come back to where it should be. And this is for two reasons. One, because whenever they open a new nursery, it takes a long time to get to full utilization for two reasons. One, when you sort of enter a child in, you tend to enter at the youngest age, 0 to 18 months, whereas people don't tend to enter in just at age 5 or age 4. So it takes almost 5 years, for the whole school nursery to fill up, and obviously when they're only half full, they're just not making as much money. But there's a second reason, which is that when you have the infants of 0 to 18 months, you need one carer for every three children, as opposed to one carer for every 7 children when they're 5 years old. So as they get older and as it matures, the margin becomes better. And during COVID, because a lot of people left, a lot of the stores are now sort of underutilized and not mature. And when that fully happens, the earnings uplift is going to be still really quite significant, and as a result, we see quite a lot of upside there. I mean, UPS we've already discussed, but again, we've had the union negotiations, and we now have the path to re-establishing the operating margins, through the pricing power that the business has, but also through some of the technological advancements that are leading, to just much greater efficiencies. Now, Samsung and Capgemini are both businesses that we believe will be beneficiaries of AI. So, maybe I'll just sort of step back a little bit and just say that when we see, a big theme like AI, whilst we're not going to jump on the bandwagon and buy NVIDIA, we do look at it and go, okay, is there any other way that we can benefit from it? Are there any other stocks? And Samsung we already owned. We realized, well, actually, memory is absolutely vital to all these data centers. You cannot have all these data centers and all this AI work without memory. But it's it's much more. Well, I say it's much more competitive. There are two as opposed to one, but it's it is a more normalized business. It's not. It doesn't have the hype. It's not over-earning with the excess margins. In fact, recently it's been under-earning because it's just been at that part of the cycle. But now the cycle is turning, the prices are increasing, and as the demand increases, as we believe it will, pricing, margins and revenues all have to increase. And it's trading at a very, very reasonable multiple, which again just gives us that margin of safety. Now, Capgemini, so they are a systems integrator and technology business. So, when a company wants to introduce new software or needs a technological solution, Capgemini is who they're going to, one of the people who they're going to go to. If not them, maybe Accenture. Now, if you think about the complexity, even in a small business, where when we've tried to introduce new software, it can be a bit of a nightmare. But it's the sort of thing that a small firm or we could do ourselves. when it's Johnson & Johnson and you have 100,000 employees all over the world, there are very few people that can do it. Your local IT guy is not going to be able to install software, in 50 locations in 50 different geographies. There are only very, very slim number of companies that can do this, and Capgemini is one of them. But they're doing a lot of things to improve the business. This is before we start talking about AI, from making things more productized, from right-sizing the pyramid, from their offshore base. But if you believe that NVIDIA is going to keep growing at 20%, and if you believe that AI is going to absolutely revolutionize the world, then this is a business that has to benefit for two reasons. One, because actually the writing of code for themselves is going to get a lot cheaper. But two, how is Johnson & Johnson going to implement these really amazing new bits of software without Capgemini? How is it going to fit in with all the other systems and processes they have? I know that some people have said that AI is going to democratize writing code, and that your CFO is going to be able to write an app. And we have seen people in our office with no coding experience all of a sudden able to create stuff. But there's a big difference between being able to create something that does a nice little function and something that is actually going to integrate in your whole of your operational systems. I don't think anyone's going to let a CFO do that. Not for many, many years. So this is one we're excited about. And then Vistry, this is a business that I really, really do like. And, we were talking about it this time last year again, but this is one that was one of our biggest detractors last year. However, it's now one of our biggest contributors, if not the biggest, as it's, up, I think about 95%, for the year, which, is fantastic. But also fantastic because all the things that we thought were happening are actually happening. They're pivoting towards the partnerships. This is their asset-light model, where they don't provide the capital for the building of the houses. That is done with councils and with third-party providers like BlackRock, Blackstone even. And the actual home building that they have, they're running off the land bank, that sort of big, sort of bulk of assets. They're going to run that off and return the cash, which is a huge capital return. About a quarter of the market cap, to shareholders, to our shareholders. Now, one of the other reasons that I'm quite excited about this, and it's now there are a few other investors who've, been talking about it in the last few months, sort of telling everyone what we've been thinking for a while, is that this move to a capital light model is actually very, very reminiscent of an American business called NVR. Now, NVR, I think they started in the 90s. But since then, they've never really grown above 10%. Their returns on capital have been stunning. They've been in the 30 to 40% range. They've had good margins, but they've never traded a multiple of more than, 20, but usually in the realm of 14 to 18. And this is all actually very similar to Vistry. Vistry have, similar growth profiles, similar returns on capital, especially the incremental returns on capital. And in fact, they now have one of the similar board members because, was it Starboard who got involved and put one of the former directors from NVR onto Vistry's board to make sure that they follow this model. Now, had you invested in NVR in the 90s, you would have made 4,000% now. 4,000%. There are very few companies in the world that have done better than that. And this is a really boring business. But again, if you'd done quarter of that return, you would be very happy. So if Vistry can follow it to, just a fraction of that, we think we'll be very happy and the investors will do very well from it.
Thanks, Aubrey. So before we start questions and answers, I just want to emphasize something. The reason we are extremely excited about our portfolio today and the prospects of our fund's performance over the next 3 to 5 years is very simple, and it's core to what we do. We own great businesses. We think they're trading at very reasonable valuations, unlike what we've seen with the Magnificent Seven and the index overall, which is probably on the high end in terms of valuation. And we think that some of the headwinds that some of the individual businesses had experienced during that period, whether it's rates or inflation or idiosyncratic specific things like the Teamsters issue, the UPS, are now behind them. And so we think when we're talking to management teams of the businesses that we own, they're extremely optimistic. They see the growth. Their margins are expanding, and we own them at very reasonable valuations, giving us not only a margin of safety on the downside, but that extra kicker on the upside. And so we're very optimistic about the future, and we're very excited to show you over the next 2 to 3 years what's going to happen. And back to you, Lee.
Well, thank you very much, gents, for that fantastic insight. I've got to say I'm personally excited by some of those stocks that you've mentioned, and quite phenomenal numbers as well. First of all, with regards to your audience, I really appreciate the questions that have come in. I've had some fabulous questions, so now I'm going to put the panel on the spot, which is always good. So first question to you, gents. You mentioned Tesla, albeit briefly earlier on. So what are your views on Tesla?
Aubrey, you want to take that one?
I don't, okay.
We have to have this every time.
We do. It's, is it the same person that asks every
I
time?
wonder.
Well, look, I mean, it's good to see that the share price is finally, starting to see sense. Yes, they're great cars.
Are they?
Well, no. Well, okay, I don't drive one, but a friend of mine does, and they are...
People love them.
People love them, yeah. And it seems great. But valuation is still stratospheric. They're still worth, or valued at, almost all the other car manufacturers, which just, let's face it, doesn't make sense. But competition is really hotting up now. Electric vehicles, the amount that are coming out of China is, incredible. And, I struggle to see how they're going to compete there. But also the number of high-end cars coming from, whether it's Polestar or, Mercedes, you have a business price like there's no competition, and the competition is just now there, and they've pretty much caught up. But then I also wonder about Elon Musk himself and execution, because yes, he's done some amazing things like Starlink and SpaceX, but then he promised the new Roadster, which has never happened. He promised solar tiles, which they've had massive sort of publicity launches, and that never happened. He did give us that really hideous kid's drawing of a pickup truck.
I saw one on the road.
Yeah, you said that. Wow. Who was driving it? Who? I don't know who would buy one of them. I mean, it looks like the sort of thing I would draw when I was 10 years old.
It is a lot uglier in real life than the pictures.
Oh,
I can tell you that.
No. But yeah, so I wonder. Yes, and then Elon Musk himself. Well, I don't know. He probably doesn't care about the likes of us, given that he's supposedly worth however many billions. But
No, he doesn't care about us. And we've said this before. In the end, when we invest in a business, we become partners with management, and he's not someone we want to be partners with.
no.
Well, thank you, gents. That's a real insight for Tesla. Hope that answered the viewer's question. Right, another key question that's come through, and always a favourite, is your views on interest rates.
Well, this is a really hard one. Genuinely, it is a hard one.
Yeah.
And we would never attempt to actually answer it, because I think if you asked, let's say if we're talking about US dollar rates, and if you asked Jerome Powell what the number is, if you ask him 3 months ago and now, you'd end up with different answers. So who are we who are we to tell? The only thing I could probably kind of guess is in terms of directionality. And it seems that, for example, in sterling and euro, where we're going to see cuts at some point in the near term. And it sounds like maybe in dollars it's going to take a bit longer. But that's basically the most educated guess we could get. Anything beyond that, I think, is just trying to look like fools. I don't know if you've got anything to add.
Well, again, I'm not going to predict where they go, but I do think we're at a weird stage of the market cycle where, really the tail seems to be wagging the dog. Because I remember one commentator saying, "Oh, it's great news. We've had a bad economic print."
Yeah.
How's he going to follow this up? Well, see, the market's up because of this bad print, because this makes it more likely that rates are going to go down. Yeah. The market is up because we've had a bad economic print, because that means okay. Yeah, I mean, I get it, but it shows us how short-term the market is. That, fundamental bad news that impacts over the long term is outweighed by the short term that interest rates might have, which interest rates are only going to affect the multiple, which, by and large, the difference of a couple of points, a couple of basis points either way is not going to make any difference to your portfolio 20 years from now.
No.
A great business that is compounding at 20% is not going to be impacted by whether interest rates are at 4 or 5%. But what do we think about, let's say, how it does impact the portfolio? Well, if rates go up, well, we don't want leveraged businesses, so we don't have leveraged businesses. We look at how sensitive our businesses are on a fundamental level to interest rates. And we try and make sure that we win either way. So we do have businesses that will clearly benefit from interest rates, like Vistry and Helical, and British Land, for very fundamental reasons. But equally, if interest rates go up, other businesses of ours will actually probably do better, as there is quite a lot of competition now, and one of the problems that we've had with interest rates being so low is that it has allowed a lot of bad competition to happen. But equally, if they go down, again, there's benefits. It's when we think about it, it's not what's going to happen. It's more, how's it going to impact the fundamentals, and can we make sure that we win either way, or that if not an individual name, the portfolio as a whole will win either way.
Yeah, I agree. I think while some of our names have clearly suffered from higher rates, I think in the medium and long term, it's been a net positive, because it leads to more rational economic decisions across the economy and less wasteful economic decisions. And in specific cases, it actually shook off some of the terrible businesses that only existed as competition because rates were near zero.
Exactly.
Yeah.
Thank you, gents, for that insight. Okay, so I'm just going to come now on to companies, and I'd really like to gauge your thoughts. It might be different for both of you, but I'd like to gauge your thoughts on which is the most exciting company that you've invested into.
I mean, current holdings, I guess.
Yeah, let's go current holdings and why.
It's a hard one because, well, for one, I have from a personality point of view, I hate the best movie, the best song, whatever. There's a time and place for everything, and there's a reason why you have a portfolio, which is you really don't know which one is going to work out the best. If you did, you'd put all your money in it, right? So in a sense, we build a portfolio knowing that A, B, and C, one of them will do very well, one will do okay, and one will probably disappoint. But we don't know a priori ahead of time which is which.
But also, as a strategy, as we've just said with Vistry, we like boring.
Yeah. I think if you want something exciting, take $100 and go to the casino. If you want to be an investor, then I genuinely think investing should be like watching grass grow. Like, you look at it, you check 5 minutes later, and you check a day later, and nothing seems to happen. But if you let it sit for a while, you discover just how much it grows over time. And I think in a fundamental sense, that's the way it's meant to be. And I think people just get too excited and want to make a game out of it. And obviously, Wall Street's interest is in getting more commissions from trading and stuff like that. So they cheer on, and everyone makes this whole... I mean, the fact that there's 24-hour business news on television, I know this is not new. It's been around a while. Or for that matter, apps on your phone that give you alerts every time your stock moves by 1% or 50. It's just absolutely ridiculous. It's an absolute waste of time. It adds no value to society or to the economy. We're investors. We're not speculators. I know we differ a bit on one specific thing, which is I would be of the opinion that the stock market should open once every 3 months or 6 months maybe. Everyone can get together and they'd agree what they want to buy and sell, and then they call it a day. And I know people like you in marketing, probably this is not in your interest to do that. But I think fundamentally, economically, for society, that makes a lot more sense. This idea that we have to have an opinion about where a stock is and we buy and sell it every second of every day. And people now talking about, I mean, some of these apps now allow you effectively 24-hour trading. I think it's just ridiculous.
Well, I mean, maybe if we go to stocks that are outside the portfolio, and actually I could go to stocks I've owned before I joined Mayar, because there was... well, the phrase "boring is beautiful" did not always apply. Certainly not at hedge funds. So actually, there's one that I did find really exciting. Maybe other people won't, but which is Sophos, which is an antivirus company. And I was pilot fished, so I met them about a year or two before IPO and got to know them quite well over time. And but one day they took me to the war room, which is sort of where, you know, they have all the sort of threats, current global threats. And that was quite cool. And they were telling us how hacking actually works, and whether it's global players or, or just the sort of banal. I mean, actually, what was quite frightening was the banality of, a lot of hacking. In that, there are people who just write little bits of code and sell it on the dark web, and then. So there's no one mastermind. There's just lots of people doing little bits, getting lists of websites with vulnerabilities. Someone else who writes a bit of code to exploit that vulnerability. Someone else who writes a bit of code to, take the money from it. And that was sort of quite frightening just to see how there's this whole ecosystem of hackers, and then how Sophos tried to protect them. So that was quite exciting. I guess the other one that's exciting, which I don't know if you could call it investment, but was when I was shorting on Wirecard. And speaking of hackers, they actually tried to hack my account and my brother's. They were they were bad people. But surprising, I think it's one of the few companies where some of the fraudsters are actually in prison. But also now rumoured that they. Well, we sort of speculated at the time that they're involved with the KGB. They were definitely involved in money laundering, some hideous things. So that was exciting. But here's the thing: it doesn't lead you to sleep well at night. Mm-hmm. Yes, when you're being hacked, and I mean, one chap I know, he was more than hacked. They visited him. Some Eastern European gentlemen visited him and told him to stop writing about them. Or one friend was about to, he got a phone call saying, we'll pay you $3 million not to publish that report, on our company. He calls his boss and goes, boss, someone's offering us $3 million not to write a report we're never going to write a report on. That is excitement I could do without.
Right.
Boring is beautiful. As I said, look at NVR. That business never grew more than 10%. Well, I've said this, but 4,000% from a boring business. And actually, the other day we looked at a long list of top performing stocks. And whilst yes, you've got your Nvidias there, you've got some, exciting stocks. What actually really surprised us was the sheer number of boring stocks. Rationale, the oven maker, businesses that you just sort of never expect to see in the sort of top 10 of top performing stocks over
JD
30 years.
Sports.
Yeah,
Yeah.
things you know, which are just boring, but well managed, solid growth, really high return businesses just do well over the long term.
Yeah.
Sorry.
No, you're absolutely right. I mean, I'll tell you the other thing. This August is going to be the 21st. It'll be 20 years since I launched the strategy, so including the period pre Mayar. So there are a handful of names. Some I actually have owned since then, that are 10 baggers. So they've gone up by more than 10x over that time. And the thing I think that is, at least from my experience with them, was Microsoft when I bought it in 2011, or Visa, again, no, summer 2011, or LabCorp in 2003, and Apple a bit before that, a bit after that, but in I think 2009 or 10 or thereabout, is at the time that we bought these things, they were not exciting. If anything, there was an element of uncomfortableness buying them. And there's always this thing with value where this is why margin of safety is important. When you buy these things, it looks, at least from the outside, it looks bad. I mean, if you're going in and everything looks great, I think you're missing something. So I think the opportunities, the investment opportunities that end up working out so well over time are ones that make you a bit uncomfortable when you get into them. And they're not exciting. You go in and you think, hope this works out. Luckily, I'm diversified. So you demand the margin of safety because you go in thinking this might not work out, and I want to make sure that I don't lose a lot of money if it does not work out. But they end up with amazing outcomes over time through the power of compounding. But I don't think they're exciting when you start. I mean, as you said, sometimes if you're doing short-term things, then it could be exciting. But most of the things that work out over time are just boring and nothing to write home about. And they have years where they do well, and they have years I mean, Visa we've owned for 14 years now, and there are many years where the stock has gone nowhere, but it's up, I don't know, maybe 12x, 13x since we bought it. So it's just, this is where patience, I think, is extremely important, and maybe having a bit of thick skin when you go in.
I like thick skin, and I like boring is beautiful. But on the Magnificent Seven, and obviously we spoke a fair bit about that today, right? It's been really important and obviously had an impact on the performance. At what point would you look to consider some of the Magnificent Seven, maybe one or two, for the portfolio?
When they fall 70%?
I think, as Aubrey said earlier, these are great businesses.
Yeah.
I would say, with the exception of Nvidia today, because I do have big question marks about kind of where margins are going to go. But obviously, if it fell down in price by 70-80%, then it could be interesting. And obviously, if we knew what happened since then, in terms of the fundamental business was going to happen, we would have bought it. It's not like we don't want to buy things that go up in price. It's just these things are not predictable ahead of time, and it's easy in hindsight to see that. And a lot of the return of these names has been multiple expansion driven, not necessarily just the fundamentals getting better. We will always be valuation driven, as long as the quality metric is there. So the quality metric is something that will always, the way I think about it, quality determines whether we want to own something, and valuation determines when and how much. And so at the right price, I mean, Microsoft we've owned, like I said, for 11 years. We sold it on valuation. It will come down in price at some point, and we will buy it again. And the same with these other names. I personally think, and I don't know, I'm not making, I guess I am making a prediction here, but I will go out on a limb and make a prediction. I think the next 3 to 5 years, from a relative performance basis at least, are going to be one of the best, if not the best, that we've had for us since inception. And the reason I think that is I think the index will disappoint over the next 3 to 5 years. Whereas I look at what we own and I have high confidence that we're going to generate good total returns from the names that we own over the next 3 to 5 years. And you put these things together where I think we're going to do well and the index is going to go nowhere or decline. And I think the relative performance for us is going to be really, really good. And I think it'll be very surprising, I think, how quickly we come out of this disappointing 3-year period. And so I think for that to happen, these names would have to come down. And when they do, we will have done our homework and we will be ready to pick them up at reasonable valuations. Microsoft, I bought in 2010, 2011, and it was a business that I've known all my life. I had followed since 1999, but it was not at a price and a combination of price and fundamentals that I thought was attractive. And when it got to that price, we bought it. And there are several businesses like that that we've owned over the years that we've followed for 5 and 10 years until we bought them. So we are following these names. And as Aubrey said, they are great businesses, but everything has to happen at the right price.
I mean, I suppose it is possible, we could change our mind on a name in that our analysis could show us that all of a sudden the growth is predictable, that the margin expansion is predictable. If, I don't know, I read Microsoft's report, annual report tomorrow. I went, oh my God, actually, no, margins are going to do this and growth is going to justify it. We could change our minds. We do. I mean, I know you said earlier you like the idea of the market being shut for 3 months at a time. Well, one of the things that I actually like about liquidity is that it allows us to change our mind.
Yes, you're right.
That, there are times where we'll look at something and just go, actually, no, we're wrong on that. And, it's possible that with, Microsoft or Apple, maybe we are wrong. Maybe there is something there that we haven't seen. I don't think there is, but if that were to happen, then we'd sit down, discuss it, take it through our process, and who knows, it's possible. But it wouldn't be on our current understanding and what necessarily everyone else believes. It would be based on the fact that we had very clear visibility that earnings were going to go up to justify that multiple. Or, with NVIDIA, could it happen? I know, I guess maybe, look, if the competition comes online and just doesn't work, and we realise that they do just have a monopoly and that somehow they are going to keep those 70% gross margins ad infinitum, and then they grow into their multiple, yeah, it is possible. I don't think it's likely, but...
Yeah, I guess everything that we're answering today is knowing what we know today, right?
Exactly.
Yeah.
And the future could change. The facts could change.
And our understanding can change. Yeah. And we, as I say, I think the great thing about liquid markets is you can change your mind. And it's one of the big advantages that, you have in liquid markets, and we will take advantage of that.
And we do that all the time.
Yeah.
I mean, as much as we have things that we've owned for 10 plus years, there are things that we've owned for a couple of months, change our mind, or the facts change and we've sold them. I mean, so
yes.
we've because again, it's the market and the economy are dynamic, so things change all the time.
Yeah.
And we make mistakes all the time too. I mean,
And we're learning all the time.
yeah,
Exactly.
it's what makes this job exciting.
Yeah. No 2 days are the same, right?
Absolutely.
I think we've got space for one more question. And we kind of touched on this, but I want to hand it over for you to leave some lasting thoughts with our audience today. So how optimistic are you about the current portfolio?
Do you want to answer that first?
Well, I think, you almost already answered it by saying yeah, no, look, I mean, we have some great names in our portfolio, and the conditions really seem ripe for them to do well. And yeah, I mean, you just listened to what I've said about some of the stocks earlier. But I think also what I like about our portfolio and about where it is now is, perhaps slightly similar to what I was saying about interest rates. Well, if interest rates go up, some of our portfolios can do well. If they go down, another bit of our portfolios can do well. When I was talking about AI, we have the likes of Samsung and Capgemini that will benefit. It's that I think we're nicely positioned that actually sort of whatever happens, well, I won't say whatever, if COVID happens, all bets are off. But, that under a lot of normal circumstances, normal possible outcomes, I can see how our portfolio does well. And that I find very reassuring.
Yeah, and the only thing I would add to that is that I see all of that, and I don't see a lot of risk that we're taking in order for those outcomes to happen. Whereas if I look at the S&P 500, I see a lot of risks where if A, B, or C happens, I could easily see it really doing poorly over many years.
I mean, the only caveat I will also give is that if we do have a big market correction because Nvidia collapses, then a lot of stock prices are going to be down temporarily.
Yeah, obviously. I mean, the way I guess we always think about it, because we think about this naturally. It's good that you mentioned it because I tend to forget to mention it. Is in the short term, anything can happen. So when we think when we say we're optimistic and we say we're going to do well, we're thinking about a 3-year, 5-year horizon from where we are today, as opposed to 3 months or 5 months, or because who knows? I mean, there's that famous supposedly there's no record of a congressional hearing where J.P. Morgan was asked, "What do you think the market is going to do?" And this is the actual J.P. Morgan back in the day, and he leaned into his microphone and he said, "It will fluctuate." And I think that's basically what's going to happen. We don't know what's going to happen in the short term, but we can only look at the fundamentals, valuation, the risks that we're taking, what we think is going to happen in the future, and think 3 to 5 years out. And on the basis of that, I'm extremely optimistic about the next 3 to 5 years. We talked a lot about relative performance, and you can't eat relative performance. I think it's just, I mention it because we've had bad relative performance the past 3 years, but I'm also optimistic about the absolute level of performance over the next 3 to 5 years for our holdings.
That's fantastic, gents. Thank you very much. I think the insight provided today has been fabulous. That just leaves me to draw this session to a close, the annual general meeting. So thank you again for your contribution. And I'd like to thank you to the audience as well for taking the time to spend with us today and listen to our thoughts and views on the markets, in particular the Mayar Responsible Global Equity Fund, and also for the questions that you've posed to us. So without any further ado, thank you again. Have a good evening and afternoon and all the best. Thank you.
Thank you.